We are less than 24 hours from tomorrow's crucial Fed decision. Joining us now is Vital Knowledge founder and president Adam Crisafulli. Adam, seems pretty clear they're going to be able to pause after the CPI number today and the markets. Sigh of relief reaction. But I wonder, when you look at the NASDAQ, it's at those high levels from January through May of 2021, where it bumped around before shooting up to 16K. So might this level here actually be reasonable?
I think it's reasonable. I think what I'm focused more on is the discrepancy or the dichotomy between the tech outperformance, NASDAQ outperformance, and certain other pockets of the market. I think overall, the fundamental backdrop is relatively favorable, and so the tech rally is justified, but I do think it is stretched versus the rest of the market. So my view is that there's going to be more of a catch-up trade in some of these other groups, like the equal weight S&P or banks, some of these groups that have lagged behind tech. But, tech had a decent earnings season. You do have a lot of excitement around this new technology with AI. Some of it might be a little bit ahead of itself in the near term. But like I said, I think it's more the catch-up trade that's more appealing.
Well, but if it's reasonable here, that doesn't necessarily mean, I would imagine, you want to rotate out of it. That's what I'm wondering.
No, I don't think, I wouldn't necessarily short tech. I wouldn't commit incremental money to it up here. You kind of see in the price action something like an Oracle today. Terrific earnings, terrific guidance, very strong fundamentals. The stock faded intraday. The AMD AI event, the products are very important. They're going to be important for the company going forward. You're going to speak to the CEO a little bit later this hour. But, as far as the near-term story, a lot of it is priced in. So it's more just, I think, committing new money to some of these other areas of the market that have lagged behind, that don't have as much enthusiasm, that have more appealing valuations.
So, Adam, what do you think is compelling in terms of a catch-up trade? You had the Russell 2000 today rally 1.3%. You had materials and industrials and some of the other more economically sensitive sectors within the S&P leading the gains today, too. I'm sure in part because of the China stimulus chatter and some of the news we see coming there. I mean, are these areas that you'd be putting money to work or somewhere else?
I think some of those, but I think more banks or energy or Chinese stocks themselves that have really underperformed. There's been a lot of enthusiasm around China the last several days with stimulus actions. We're going to have Blinken visiting Beijing in the next week or so, according to reports. But Chinese equities themselves, so Hong Kong, mainland China, have lagged behind a lot of what's happening in the U.S. So I think Chinese equities, have more potential to catch up. Bank stocks are still big underperformers. Energy has catch-up potential. So to those areas that I think are a little bit more appealing, than the overall S&P or tech.
Yeah, and just to go back to the CPI print that we got this morning, the fact that we have seen headline inflation now halved from the peak of last year. Is disinflation still a good story for the market and for equities here, or are there risks?
So I think for the time being, intensifying disinflationary forces is certainly positive. I think it will stay positive. I'm a little bit concerned, a quarter or several months from now, I think that disinflation is going to create some obstacles for certain companies in terms of earnings. And so there definitely could be some issues as we get more into the fall and prices continue to drift lower, that you start to see companies have earnings problems because of that. And then it's going to create some hiccups for the market. But I think for now, it is a tailwind in general. But again, as we get into the fall, if it hurts earnings more than it drags yields lower, it's going to create some obstacles for the overall market.